Thanks very much for taking out the time. Good to get you on a day like this. Obviously, the anticipation was for a slightly more negative start, but considering the kind of sell-off that we've already been, witnessed so far, where we've been off 11% from the highs, at a time where the global markets were actually moving higher. So the last 6 days have been bad for US equities, but they've given up about 5.5, 6 odd percent, but we've given up about 11%. So in light of that, do you believe that this selling has been overdone now and there could be a possibility of a turnaround from here, or the pain can still continue?
Well, I think the market clearly in the very short term has kind of overdone it because of obviously quite a number of factors which we are aware of. But we've underperformed a great deal, especially with respect to many of the other global markets, emerging markets as well. We are negative year to date, whereas many of the other markets are positive 10% plus in dollar terms. So I think obviously we've done a lot more in the very short term, and therefore from very beaten down levels, I don't rule out a possibility that there could be a pullback.
Mm-hmm. Okay. But what do you think you can attribute such a pullback to? Is it just going to be the fact that we've been so heavily oversold that could be a technical trigger to pull the markets higher? Because other fundamentals are clearly not supporting.
So you're right, actually, that we don't really have everything on the fundamentals which is going our way, particularly from a growth perspective, as we know that we have kind of faltered quite a lot, and the growth challenges has got a little deeper in the recent past. It has kind of disappointed us as well in terms of our own estimates, and we have pushed back our growth estimates further into probably the beginning of next year, as such, from the second half of this year earlier. So clearly from a growth perspective there is a disappointment, but I think there are a few other macro factors which are still in our favor, and if you look at everything from interest rates to inflation to commodity prices to oil, to up until recently even the currency for that matter was still pretty okay and reasonably favorable for us. So it gives us a chance as an economy to kind of walk out of trouble, especially in a situation where we currently don't have any policy support in favor of the economy. So I think and last but not the least, of course, in the last couple of weeks we've seen very good developments on the monsoon. We've almost brought down our deficit from about 25% to less than 5%. So I think that's good going there. So we have a few things to cheer about. I mean, it's not entirely gloom, but yes, I mean, from a growth perspective, we don't really have a choice but to postpone our growth assumptions.
The other aspect, Taher, that would like your view on is, so far in this uncertain environment, even from a mutual fund industry point of view, there has been that shift in terms of investing, or the polarization on the index heavyweights. So top 10 heavy-weighted stocks, we've seen much of the mutual fund industry pouring in the money into. Do you think that is somewhat reaching its peak?
Well, I would think so. I mean, at one level, if you go to see, the broader market is clearly offering a lot more value now. And when I refer to the broader market, it just doesn't end at mid and small caps. It is many of the large caps as well, which are kind of, so barring a few of the top large caps, a handful of the large caps, quite a number of the large caps, other large caps have also corrected and have started to offer value. So I think clearly from that perspective, maybe that very risk-averse trade at one level has been a little overdone as of now, and we think we are at the other extreme of the market, where I mean, compared to what we had seen in 2017-18, where the broader market was really doing very well, whereas not as much in the case of the large caps. So I think from that perspective, we feel that we are at the other end of the pendulum, and things typically do mean revert.
Good morning, Neeraj here. I'm just wondering, because you look at this global landscape very closely too, because of the nature of the turn of events that has happened between US and China, if there is prolonged pain there, even if we have oversold, how high is the probability that we may correct further from where we are?
Well, I think it's always hard to call on some of the global developments, particularly with respect to US and China. It's it's absolutely all bets are off in terms of who can be able to call what's going to happen out there. But we have to take it as it comes, and we have to kind of look at our valuations and where we are beyond a particular point. I think there is something called intrinsic value of businesses which will hold up. So I can only tell you this, that the way we are approaching it is that, look, can we look at a scenario where we postpone our growth assumptions for a while, not just for this year, maybe some part of next year as well. And if that were to be the case, then where do values lie? Where do valuations lie? And if there's anything that makes sense from that perspective, we are happy to kind of buy. I mean, that's the way we are approaching it. And that's the best way to do it right now, so that you are at least shorn of all assumptions in the market right now.
So are there large swaths of such opportunities available, or are they very, very niche? And part two of my question then is that even if you're spotting these, are you staggering out your purchases because the markets may not go up in a hurry, or are you comfortable putting large dollops to work immediately?
Well, so from the perspective of opportunities, I think the net is getting wider, and day by day, and we are seeing many more companies fall into the value net. So that universe is clearly rising. We have seen it in our own internal investment universe that we track, where incrementally a good number of companies are coming into a reasonably decent valuation fold. But having said that, we are the one thing that we are, at least as of now, not dismissing, and we've never kind of let our eyes go off, that is that we don't really want to buy into anything which has got balance sheet fragility. We are willing to kind of bet on companies where we think that the operational challenges probably will continue for a while longer, or may disappoint us for a longer period of time. But we don't really want to kind of venture out into any company which has balance sheet risk. So from that perspective, today we still, given the fact that we are managing fiduciary money, I mean, to that extent, we are still continue to remain in a heightened sense of alert.
Mm-hmm. Okay.
And to answer your question in terms of whether we are doing it at one go, or we're doing it piecemeal, I think it makes sense to do piecemeal. I mean, we are not hurrying into anything, but we are at the same time not sitting idle thinking that the market can fall further and let's accumulate cash, and that's not how we are approaching things. We are happy to go and buy things where we see value.
Okay. So where would you stack financials in the list of value generators right now?
So it's strewn across. I mean, we have a few of the banks which look interesting to us, some of the larger ones as well, and some even in the small private sector banks, small finance banks, etc. So a couple of the NBFCs is now kind of turned value as well from our perspective, especially the ones who have kind of been able to get money in the recent past, grow in the recent past, especially after the IL&FS crisis. So they've kind of deviated from the overall pack. That is where we are happy to buy into anything which now looks a lot more comfortable from a valuation perspective. And once again, as I said, without taking any assumptions on growth at this stage. So I think there are a good number of pockets on the BFSI space which look interesting.
Okay, Taher, this whole argument that I hear, and because you guys have this particular fund which a lot of people are interested in investing in, that small cap fund. Now my question is this a good time to accumulate small caps, or are you market cap agnostic right now? Typically, I believe people wouldn't be market cap agnostic. A lot of people say that when the bounce happens, the larger companies tend to bounce back fastest, and then the smaller companies, etc., etc. In your own wisdom, would you adhere to that, or are you market cap agnostic right now?
So at one level, we are market cap agnostic, we are sector agnostic as well. But having said that, I mean, like as I said, we are governed by where we see additional value, and where we can live with low growth assumptions or zero growth assumptions for a while. And that those kind of opportunities seem to be emerging more in the mid and small cap space, simply because of the fact that valuations have kind of corrected so steeply in a very short period of time. What was, as you know, 30-40% premium to large caps is now converted into a 25-30% discount in many cases. So I mean, it's obvious, it is staring at your face that if you have a couple of years perspective, then I think it makes a lot of sense to buy into those. How should be your buying pattern? Should you be nibbling? Should you be doing it gradually, piecemeal? That's left to each individual's choices. But as a funder, we are governed by the mandate. So if there is opportunity in small cap, we are willing to buy small caps for our small cap fund, and similarly for our large caps for that matter. So at one level, you can call us agnostic.
My final question, Taher, and that's on autos, because that traverses the whole universe. Large cap, mid cap, small cap, again a space which is corrected viciously. Ancillaries have corrected viciously as well. Are you of the belief that there is a bounce that can come in, and therefore, if indeed so, are these valuations where you would be comfortable parking money in?
So we've been assessing this space almost on a daily basis, and I think we've come to a stage where it's not that the whole sector is value. There are a few pockets where if you were to probably suspend growth assumptions for a while, then it's not really cheap enough. They're getting there, but they still have some distance to travel. But there are a few pockets at the same time which are kind of turning value. They offer some dividend yield as well, and they are at averages. They are at multiples which are at long-term averages or even a shade below them. So I think it's different strokes within the sector itself. From the perspective of growth, like as I said, overall I would like to be a lot more cautious in terms of making any aggressive growth assumptions. But in the absence of any great policy support, or it'll be left to market forces. It will have to come to a situation where manufacturers, OEMs are able to clear inventory gradually, either by offering some good discounts, etc., or for consumer sentiment to gradually improve, and that will lead to inventory levels coming to a point where eventually we start seeing growth. So I think in that situation, if it is left to market forces of demand supply, it is going to take a while longer than one would ideally expect. Let's see how it goes. We would like to see some interest rates percolating down in the system. If that were to happen, given that oil prices, etc., are favorable, I think we should see faster resumption of consumer sentiment. And if that were to happen, then we would be back to growth a little quicker than we expect today.
Okay, got that. Taher, it was a pleasure chatting with you this morning. Thank you so very much for joining in.